Hi, I'm Giselle Roux. Welcome to the Inside Network. Good morning. We're here with the Inside Network doing a conversation with Matt from Conscious Investment Management. Good morning to you, Matt.
Thanks for having me, Giselle.
So let's start a little bit on who you are, the team, the background, because I don't think many people will be familiar with your organisation.
Conscious Investment Management is an impact investment manager that we founded a couple of years ago, predominantly focused on real assets. And when we say impact investment, what we mean is investing to earn a market rate financial return, but have a tangible, measurable and positive social and environmental benefit. What that typically means is there are some sectors which we default to invest in within real assets, areas that you can invest in to earn a return and that benefit from profit-seeking capital, but can also have impact. So we focus on investing in environment and climate, health and education, and sustainable development.
So let's unpack that a little bit further, because everybody's peppered with ESG, sustainability, impact investing. Should people think about this as being not ESG, not sustainable? Is it a very different category? And what is distinctive about your approach in that?
Impact investing, as fantastic a sector as it is and as promising as it is, does suffer from a lot of false precision in the term. Perhaps we can use a case study to talk about that. I think about if you have $100, you can really invest that on a spectrum of different things. The first is you can invest it with no consideration of the impact it has. That's purely financial returns focused. Or you can give it away to philanthropy. That's a negative 100% financial return. Coming in from the financial returns side, we have things like ESG screening, where we might rule out some sectors that we don't want to invest in. Coming in from the philanthropic side, we have a bunch of people doing concessionary returns investing. An example of that might be buying a building and giving it to a charity rent-free, where you're having an impact, but you're not earning market rate financial returns. We really sit above that dichotomy. We've got a unique model, and everyone says unique, but a unique model of partnering with charities and other social enterprises to originate investments. Structure investments which have a social impact for their clients, and then working with them to manage assets that we acquire. I'm conscious that I and the investment team don't have lived experience of many of the problems we're seeking to solve, and by working with charities or other social enterprises or corporates, we can really achieve impact and investment.
So let's once again delve a little bit deeper into that. You invariably come under the ambit of some kind of government regulation or process, so that's one side. And on the other side, as you mentioned, you've got a charitable or some other similar style of entity there. So that's very different from normal investing that people do. Yeah. So how do you account for the involvement of those two people within the process?
I think on the government side, you may be referring to say regulatory risks, which we take on investments. The link to government obviously comes about because our investments are often addressing fundamental social needs, which typically are sectors that government has supported or perhaps should be supporting in the absence of an impact investor. And we really account for risks around governments and charities the same way you'd account for any investment risk, and that's really a three-step process. The first is identifying a risk or a regulatory risk which we face up front in our investment decision making and getting to know it and how we'll manage it. The second is managing that risk throughout the life of an investment. If I take, for example, an investment we have in specialist disability accommodation, we will join industry panels and throughout the life of our investment make sure that we're fully up to speed with ongoing regulatory movements. And the third way we manage risk, which is no different to any other investment manager, is to have downside protection in all of our investments. Again, to use the example of specialist disability accommodation, which is an investment we've made acquiring a really high amenity apartments throughout capital cities and retrofitting those to make them friendly for Aussies living with disability. The rent on those is paid by the government. We can ultimately, if there's some adverse regulatory change, sell the apartments for their residential value, and in that way, even when the government's involved and we are facing government regulatory risk, we can mitigate our downside.
So let's go a little bit more into some of the sectors and some of the specific. Can you take us through an example of something you looked at and then worked progressively your way through into investing?
As an investment manager, we run a bunch of co-investment mandates and separately managed accounts, but we also have a diversified impact fund, which called the Impact Fund, very uncreatively. Obviously, I'm not a branding person. And that seeks to earn returns of 7 to 11% per annum with a focus on cash flow yield. And what that typically means is our investments are stable, real asset backed with contracted revenues. We've invested in community rooftop solar, where we build solar panels onto the roofs of schools and shopping centres and other community assets. We've invested in affordable and social housing and disability accommodation, as I mentioned. To use the example of disability accommodation, that's a relatively emerging sector in Australian property. It's one that many viewers or listeners to this will be familiar with or will hear about shortly. And effectively what that is seeking to address a problem which exists in Australia of a bunch of young people living in nursing homes or hospitals or other inappropriate accommodation because the right accommodation doesn't exist for them. The approach we take is we work with a couple of different charities in the space that have been working with these clients for a long period of time. We go out arm in arm with those charities and identify buildings and locations where their clients might want to live. As an example, we own a bunch of apartments in a new development in a high quality building in Abbotsford, Melbourne. And we conduct a bunch of investment assessment of that building, make sure we're happy with the property, and then work with the charity to acquire apartments, tailor those for individuals and get their clients in under a long-term scheme. The effective rent on those properties comes from the government. And the thing we've found about this sector is that by focusing on the impact, by working arm in arm with charities and building the most appropriate and the nicest properties we can, we actually mitigate vacancy risk, which is everything that impact investing is about. By focusing on the impact, we can create better quality assets which are fully tenanted and improve our risk-adjusted returns.
So being clear about the impact outcome and then the financial reward, is there a risk or some kind of tension between those two where maybe the financial reward means the impact is lower, or alternatively, in order to get the appropriate income, the financial returns have to be lower? How do you measure between those two? And how do you actually assess whether that impact has been as good as what you would have liked to have seen?
It's a really good question. I think there are a couple of parts to your question. The first, which we should address, is the trade-off between financial returns and impact. And we should make this very clear. I and the team have very strong philosophical thoughts that impact investing should not involve any financial return trade-off. In fact, the second we accept lower or concessionary returns, I see us as crossing a bright black line and becoming an alternative to philanthropy, which is not what impact investing exists to do. It exists to substitute investment capital to areas of social need. What we do through our investments is focus on assets which fundamentally are better investments as a result of having impact. And they can be better investments because your vacancy risk is lower, as is the case of disability accommodation. They can be better investments because some subsidy is payable, etc. But all because of the impact they're having. I think the second part of your question was around measurement and how do we measure and manage our impact. That's an ongoing impact measurement and management is an ongoing space for development globally. There's an alphabet soup of different schemes and policies that have been written. At its most simple level, I think about the measurement of our impact as really having two components. The first is measurement of outputs. Outputs are numbers. They're things like number of cars taken off the road, number of young people we've provided mentoring through our social impact bonds, number of people we've got into beds, etc. We measure all of those, we track those over time, and we get one of the big accounting firms to audit those and prepare a glossy report that we send to our investors, so our investors can see that data with the same level of precision as they're seeing financial returns. That's outputs. I think the more interesting thing and the more authentic way for us to think about impact measurement is the outcomes that our investments are having. And when I say outcomes, what we mean there is getting into the next level of detail about what's actually going on at our investments. What's the benefit of giving someone a roof over their head or putting a solar panel on a roof? Are there any adverse consequences happening? Often we're dealing with incredibly vulnerable people in some of our investments, and if we don't manage the potential adverse consequences that could go on at an asset, then we're not achieving what we should do as an impact investor. I'll give you one example of that is we once looked at building crisis accommodation, where we were going to acquire a bunch of rundown properties and rebuild them as crisis accommodation. But to make that investment, we'd be evicting some people from the property. Now that would contribute to the social housing problem, not address it. And that's the next level of thinking which an impact investor needs to go through. The way we manage that is to get into a lot of detail in our investment committee papers and take a fully transparent approach with our investors about the outcomes that we're focused on having, the risks we see, and track that over time.
So for an investor into a fund such as the Impact Fund, just gives a little bit of the sort of hard-nosed colour. The money's locked in. Should they expect income or capital returns? How do you value the investments if there is a capital return?
We need to call the Impact Fund what it is on the box, and that is it's a long-term investment. Many of our assets are illiquid, so the fund has rolling 5-year liquidity. It's designed to be exactly the fund we needed to have social impact. We're also conscious that for many of our investors, we are the first impact investment they have made. Prior to founding the Impact Fund, I and the team ran a similar strategy on balance sheet at a large family office. So we've had a bunch of experience with this over time. But for many of our investors, it's important that we give them a good experience. I'm not a golfer, but we need to hit it straight down the fairway. And what that means is we've set up the fund so the majority of returns come through contracted cash flow contracts which people can see and understand, and it's very defensive. The majority of the 7 to 11% returns will come from cash flow over the medium term. Like all investment managers should, we have an extremely strict valuation policy, which calls for independent valuations by professional independent valuers periodically of all assets as required. For some of the bespoke impact investments we have, things like social impact bonds, we run a model internally to value those on a quarterly basis.
Let's once again turn to some of the perhaps emerging areas. You've mentioned obviously the NDIS system, and so now we've got social housing clearly in the forefront with the pandemic, and we can go back to environmental issues, which I'm sure will become prominent again. Would you look at other assets, be they agricultural, some kind of other environmental benefits with the environmental side, and conversely, do you think there is a large possibility for social housing?
I think, as a macro comment, there are so many challenges which the world and society faces, and impact investment is set up to address some of those, but not all of those. Only some areas of social and environmental need are amenable to profit-seeking capital flowing to it and seeking to earn a return. And we can all think of examples where we don't want profit-seeking, examples of need where we don't want profit-seeking capital looking to invest. What we do within our impact themes, environment and climate, health and education and sustainable development, is find the most actionable investment opportunities with attractive economics, and then partner with the right partners. So one of the key areas we're looking at the moment is social housing and affordable housing. And we're working with a bunch of charities in that space to make it an investment. I think that's become, as you mentioned, particularly acute at the moment with the pandemic, and some of the challenges of the current social housing system have really been brought to the forefront, and fundamentally social housing should be a property investment given the right economics.
Well, Matt, very interesting. I'm sure we're all going to learn a lot more about impact investing over the years. Thank you.
Thanks, Giselle.